Welcome to Markets and Economics. Today we will discuss about order types in trading. If you have ever wondered how to buy, how to sell, how to protect your capital, or how professional traders place orders, this video will explain every single order type you will ever use. We will cover market orders, limit orders, stop loss and SLM, target orders, bracket orders, cover orders, trigger price, order execution segments, order modifications, LTP, LTT, Iceberg Orders, order book dynamics, sequential orders, CNC, MIS, NRML tags, and everything needed to understand modern trading systems. This will be the most detailed guide you will ever find. Let's begin. What is an order? In the stock market, an order is simply an instruction you give your broker to buy or sell a security. But how you instruct the broker determines the execution, the price, the risk, and the outcome. Different order types exist because traders have different goals. Quick entry, precise price, risk protection, automated exits, intraday strategies, long-term investing. Let's break them down one by one. Market order. A market order is the simplest type of order. It tells the system, buy or sell immediately at the best available current price. You don't choose the price, you only choose the quantity. Pros: fastest execution, guaranteed fill. Cons: no control over exact price, possible slippage during volatility. Real app example: you tap buy, market 10 shares. If the current bestseller is at 100 rupees and 25 paise, your order executes immediately at that price. Limit order. A limit order allows price control. You specify the exact price at which you want to buy or sell. Buy only if price comes down to 100 rupees. Sell only if price goes up to 105 rupees. Pros: 100% price control. Ideal for planned entries. Cons: not guaranteed to execute. Real app example. Price is 102 rupees. You place a buy limit at 100 rupees. When price falls and touches 100 rupees, the order executes. Your order appears in the order book at 100 rupees on the bid side. Stop loss orders. Stop loss orders protect you by limiting losses. There are two types: stop loss limit. This order has two prices: trigger price, limit price. The trigger activates the order. The limit price is where it tries to execute. Example: trigger 98 rupees. Limit price 97 rupees and 50 paise. When price hits 98 rupees, your limit sell order is placed at 97 rupees and 50 paise. Stop loss market. Here you only set the trigger price. Once triggered, the system sells at market price immediately. Advantage: guaranteed exit. Risk: slippage. Target order. A target order is simply a limit sell order placed above your buy price to book profit. Example: you bought at 100 rupees. Place target at 110 rupees. When price touches 110 rupees, the system sells. Bracket order, BO. A bracket order is a 3-in-1 advanced order containing entry order, target order, stop loss order. When one of the exit orders, target or SL, executes, the other automatically gets cancelled, usually for intraday trading. Cover order, O. A cover order is a two-legged intraday order, market or limit entry, mandatory stop loss. Because stop loss is compulsory, brokers offer extra leverage. Trigger price. The trigger price is the condition that activates a stop loss or SLM order. Trigger price is not the execution price. It is the signal to place the actual order. Example: price equals 100, trigger equals 98. Once price hits 98, order gets activated. Order execution segments. Product types. Every order belongs to a segment which you choose in the app. CNC. Cash and carry delivery. Used for long-term or short-term delivery trading. Full money required. Shares are added to demat. Settlement T+1. MIS. Margin. Intraday square off. Used for intraday trading. Broker provides leverage. Auto square off before market closes. NRML. Normal orders. Used for overnight futures and options. Requires SPAN, means span plus exposure margins. No auto square off. Order modification and cancellation. You can modify price, trigger, quantity. You cannot modify market orders, instant execution. You can cancel any unexecuted order, GTT, pending targets, stop loss orders. Understanding LTP and LTT. LTP, last traded price. The price of the most recent trade. Used for viewing current market price, setting entry price, and checking order execution. LTT, limit trading trigger. Used especially in stop loss activation. LTT equals the price at which trades are occurring inside the exchange engine. If LTT hits your trigger, your stop loss activates. Order book dynamics. Every limit or stop limit order enters the order book. There are two sides: bid, buyers; ask, sellers. Your order becomes visible here unless it is hidden or iceberg. If you place buy limit at 99 rupees, your order appears at that price in the bid list. An iceberg order hides the full size of a large order. Only a small portion is shown publicly. When it fills, another portion appears. Used by institutions, large volume traders, algo systems. Goal: avoid moving the market with massive orders. Aftermarket orders, AMO. One more practical tool: aftermarket orders or AMO. These let you place orders when the market is closed, so they are queued for the pre-open session or executed when the market opens. AMOs are ideal for people who cannot place orders during trading hours. Remember, they participate in the pre-open matching and may see different execution levels at open. Order, visibility, and market impact. Large visible orders can attract other traders. Hidden orders protect strategy. Limit orders contribute to liquidity. Market orders consume liquidity. Sequential order, final advanced concept. A sequential order is a two-step order mechanism. Order B is placed only after order A is fully executed. Example: buy at 100 rupees. Once fully filled, automatically place target at 112 rupees. Used for stepwise strategies, long-term investing, hedged trades, entry first, then protection workflow. This is different from bracket order because it's not limited to intraday. Time in force. Validity settings. Different brokers provide various validity types. Day, valid for the session. IOC, immediate or cancel. Fill instantly or cancel. FOK, fill or kill. Must fill completely or cancel. GTD, good till date. Valid until chosen date. GTC, good till cancelled. Valid until manually cancelled. GTT, good till triggered. Broker's version of conditional order. Broker-specific tags for Indian markets. These are not order types, but important names you'll see. CNC, delivery. MIS, intraday. NRML, futures and options overnight. BO, bracket order. CO, cover order. Real-life workflow example. Let's take a realistic example using a trading app. Example: buy, target, stop loss, exit. Entry: price 100 rupees. Order: buy limit at 99 rupees. Placed into order book. Triggers: execute. Target: place target at 110 rupees. Stop loss: SLM trigger at 97 rupees. Execution scenarios: if price hits 110, target sells, SL cancels. If price hits 97, stop loss activates, target cancels. This is exactly how orders work inside modern trading engines. Circuit limits, freeze rules, and pre-post sessions. Exchanges also enforce circuit limits and freeze rules, upper and lower circuits that restrict price movement for the day. When a stock hits its circuit, market orders may fail and SLL orders can be bypassed. Also be aware of pre-market, pre-open, and post-market sessions. Order types allowed and how matching works can differ from normal hours. Matching methods and block auction orders. Exchanges use different matching methods. Most retail markets use price then time priority, while some venues use pro rata allocation for large orders. Special auction and block trade mechanisms exist to clear settlement shortages or to place very large trades without disturbing the regular order book. These have different rules and sometimes special order tags in the app. Pledge, unpledge, and special segment rules. Finally, some platform actions, pledge and unpledge, are instructions to your broker to use shares as collateral for margin or to release them. Also note that in special segments, GSM, ASM, T2T, specific order types or intraday features like BO/CO may be restricted. Always check broker notifications and exchange segment tags before trading. Tick size rules. In stock markets, prices do not move freely in any random number. They move in fixed steps known as tick size. For example, many Indian stocks have a tick size of 0.05 rupees. This means a stock cannot move from 101.20 rupees to 101.22 rupees. It must move in steps like 101.20 rupees to 101.25 rupees to 101.30 rupees and so on. Tick size affects how quickly prices move, how tight or wide bid-ask spreads are, how algorithms place orders within those allowed steps. Although this happens silently in the background, it shapes how every order is matched and executed. Freeze quantity limit. The exchange also sets a freeze quantity limit. This is the maximum number of shares you can place in a single order. For example, if the freeze quantity for a stock is 10,000 shares, you cannot put 50,000 shares in one single order. If traders need a higher quantity, the order must be split into multiple legs. This rule exists to avoid sudden volatility and to maintain orderly trading. Order routing delay, latency. When you click buy or sell, your order travels from your phone or laptop to your broker's server, then to the exchange. This journey takes time, often milliseconds, known as latency. For most retail traders, this delay is small and harmless. But for high-frequency traders, even 1 millisecond can make a difference between profit and loss. This is why professional firms place their servers physically close to the stock exchange, a practice known as co-location. Lower distance means lower delay and faster execution. Price bands for IPO listing days. On the first day of an IPO listing, the exchange uses special dynamic price bands. Because new stocks can be extremely volatile, the exchange may allow the price band to expand automatically when certain thresholds are triggered. For example, if the stock hits the upper or lower circuit, the band may widen from 10% to 20%, then to 40% depending on rules. This ensures healthy price discovery, reduced manipulation, smooth listing day trading flow. Market makers and liquidity providers. In some stocks, especially derivatives or newly listed companies, there are market makers or liquidity providers. Their job is to continuously place both buy and sell orders to ensure smooth trading. Because of market makers, bid-ask spreads stay tighter. Traders can enter and exit easily. Price volatility stays controlled. This system is essential for ETF trading, commodity contracts, and certain cash market stocks when natural liquidity may be low. Market makers help the market function efficiently, especially when there are fewer natural buyers and sellers. These microstructure concepts, tick size, freeze quantity, routing delays, IPO price bands, and market maker obligations represent the deepest technical layers of how our stock market functions behind the scenes. They are not required for everyday trading, but understanding them gives you a clearer picture of how orders move, how prices form, and why certain behaviors occur during trading sessions. You have now learned every important order type used in modern trading: market, limit, stop loss, SLM, bracket, cover, trigger price, order book, iceberg, sequential orders, product types, validity types, and more. This is the most comprehensive explanation covering both beginner and advanced levels. If you found this helpful, support the channel with a like, share, and subscribe. And stay tuned for more detailed videos on trading and investing.